Well, Russia's once resilient wartime economy is starting to slow down after 2 years of strong growth, driven by record military spending and redirected oil exports. Cracks are beginning to show.
Sanctions against Russia are necessary. It's important to seriously limit Russia's oil trade and its use of tankers. Sanctions, including secondary ones, tariffs, and price caps, can work and push Russia toward peace.
So, on paper, Russia's economy looks like it's on fire. In 2024, their GDP grew by 4.3%. That's more than the US, more than the Eurozone. Not bad, right? But here is the thing. GDP numbers can be incredibly misleading, especially when you are dealing with a wartime economy. So today, we are going to break down what's really going on under the surface. And stick around, because by the end, you'll see just how long this can actually last and what could bring it all crashing down. Hey everyone, welcome back to the channel. My name is Matthew and let's get into it. After Russia invaded Ukraine back in 2022, a lot of people were expecting a full-scale economic collapse. Sanctions came in hard. They got kicked out of SWIFT. $300 billion in foreign reserves were frozen. It was a financial hammer drop. And yeah, their GDP did fall by about 2% that year. But then, the economy bounced back, at least according to the official numbers. 2023 saw 3.6% growth, and by 2024, it was up to 4.3%. Even going into 2025, forecasts suggest more growth, maybe 1 to 2%. And unemployment reportedly at its lowest ever. So what's going on? How is this even possible? A lot of people, especially those who support Russia, point to these numbers as proof that sanctions haven't worked. But here is the problem. GDP doesn't tell the whole story. GDP is just a measure of how much stuff a country produces. And that includes tanks, missiles, and bullets. So if Russia builds $1 billion worth of military equipment, that counts as $1 billion added to GDP. Even if the Kiev gets blown up by the next month in Ukraine, that doesn't make the country richer in any meaningful sense. It's like printing money to build things that are designed to be destroyed. So yeah, the economy looks stronger on paper, but dig a little deeper and you'll see the engine running the show is military production, government contract, infrastructure tied to the war effort, and state paychecks for soldiers. Here is a breakdown that makes it clear. If you chart out GDP by sector, the industries tied to war spending are way up. Meanwhile, everything else, flat or even declining. And it's not just weapons. Russia's pouring money into new trade infrastructure aimed at China and India. Roads, pipelines, ports, all of that boost GDP too. But a lot of it's just shifting the economy around, rather than creating real value. Even repairing infrastructure damaged by the war adds to GDP. But again, it's not new growth, it's just catching up from destruction. But this kind of spending comes at a price: inflation. Officially, Russia's inflation rate is sitting around 9.5%, but many economists say the real number is way higher, and that suspicion is backed up by their interest rates, which are currently at a staggering 21%. Let that sink in. 21%. And once banks take on their own profit margin, people could be paying 25% interest on loans. That's brutal for any businesses that needs financing, especially if they're already in debt. In fact, bankruptcies in Russia have reportedly jumped by 20% year over year, and many analysts expect that to keep rising. So what does this tell to us? That inflation is probably much worse than what the official stats are showing. And why is inflation so high? There are a few reasons. First one, import prices. Sanctions have made foreign goods more expensive. And if you are getting stuff through China or India as a workaround, you are paying a premium for it. The second one, labor shortage. Since the war started, a ton of people either left the country or joined the military. That means fewer workers, which drives up wages and adds even more pressure on prices. And the last one, government spending, the biggest factor by far. When the state is injecting cash into the economy, whether it's to build weapons, fund the war, or subsidize mortgages, that overheats the system, and the money printing quietly happening behind the scene that only makes it worse. So, how is Russia affording all this? Two words: national resources. Russia is still selling oil and gas, just not to Europe anymore. Back in 2022, when the invasion started, global energy price spiked, and Russia made a fortune. Even though revenues from oil and gas have dropped compared to those heights, they are still solid, more or less on par with what Russia made in 2021. And while Europe has moved to cut itself off, countries like India and China have stepped in. India, for instance, used to buy almost no Russian oil. Now, they are getting nearly 40% of their supply from Russia, often at a discount. And China's not just buying oil, they are helping with equipment, trade system, even military parts. Since 2022, trade between these countries has exploded. And now, the Chinese yuan has basically become the go-to currency for Russian international trade. Meanwhile, the ruble keeps losing value. Since the annexation of Crimea in 2014, it's been a long decline. That makes import even pricier and puts more pressure on the average Russian household. So, how long can this last? Honestly, quite a while, at least from a financial perspective. Russia still has a deep well of reserves. The central bank claims to hold over $200 billion worth of gold, which has surged in value, up around 75% since the war began. Their government deficit is expected to be about 1.7% of GDP in 2025, which, by the way, is much lower than the US projected 6.5%. And despite all the sanctions, Russia's public debt is still extremely low, only about 16% of GDP. That's one of the lowest ratios in the G20. So, technically, they've got the runway to keep this going for a while. But, and this is important, just surviving doesn't mean the economy is healthy. Russian citizens are dealing with high prices, reduces access to foreign goods, and lower quality across the board. With less foreign competition, local companies have little incentive to innovate. Productivity drops, quality slips. Once the war winds down and the states start pulling back on military spending, that's when we'll really see how fragile things are. Add in an aging population, brain drain, and the fact that the foreign investors are staying far away, and the long-term picture starts to look pretty bleak. Russia is still making money off energy, sure, but if oil and gas prices dip, that caution disappears fast. So yeah, the economy hasn't collapsed, but that doesn't mean it's thriving. GDP grow and low unemployment look great on a slide deck, but when interest rates are at 21%, inflation's running wild, and businesses are closing left and right, that's flashing a warning light. Let me know in the comments, do you think Russia can keep this up? Or is it all just a house of cards? And if you are curious which companies might be the next Nvidia or Palantir, I've got a video breaking down the most promising stocks of the year. You can check that out here. Thanks for hanging out, and I'll see you in the next one.